So before we look at the next one, can we briefly review the concepts we've discussed so far? So far we've looked at one, the going concern concept. I think you are going to assist me, Prof. Ashley. What concept have we discussed? Prof. Ashley, can you hear me?
Yes, please.
Okay, so can you name one or two of the concepts we've discussed?
The historical cost concept and the business entity.
Historical cost concept. Then the business entity concept. Great. Prof. Sandra, can you add two?
Accrual or margin cost concept.
The accrual
and
or
business entity concept.
margin. And then we had the consistency concept. And finally, the prudence or conservatism. I want to believe at least you know a bit about each of them. So quickly, going concern means the business is going to be in existence into the future. It is not going to die. That's the assumption. Historical cost says that you record revenues, expenses, assets at the prices or at the values at which the transaction occurred, right? And the business entity concept says that the business should be separate from its owner. Okay. Accrual says that you record revenues as you earn them, regardless of whether monies have been received or not. And you also record expenses when you incur them, regardless of whether you have paid or not. And the margin says, make sure you compare revenues to their expenses for the same period under review. Consistency, that is very simple. Maintain the same policies and methods. Do not change them unless there is a reason, a tangible reason to do so. And in doing so, disclose it to all interested parties. Prudence or conservatism says the accountant should make provision for future possible losses and should stop the habit of predicting profit or anticipating profit. Great. Let's move on to the next one, which is money measurement. Money measurement. I think this is the basis of financial accounting in the first place. Money measurement. So this concept states that the financial accountant should only be interested in events that have money or monetary characteristics. Okay, so this accounting concept says that only financial transactions will find a place in accounting. So only those business activities that can be expressed in monetary terms will be recorded in accounting. If an activity does not have any financial or monetary transaction, or I should say characteristics, financial accountants will not record them. So that is money measurement. Okay, the accountant is only interested in events that have monetary characteristics or features. Okay, so it means that if something happens and there's no money or monetary terms in it, the accountant will not record. Okay. The next one is realization concept. Realization concept. realization concept. Now, if you are not careful, this concept will look like the accrual. Okay, but realization concept only bothers about revenue recognition. Okay, revenue recognition. Sometimes you can refer to it as recognition concept. So it assumes that revenue should be realized when the major economic activities have been completed. So key words, the major economic activities have been completed. So this concept is really focusing on at what point can you say you have earned revenue. Okay, you can only say you have earned revenue when you have done the major activities in the transaction. So for example, if you are selling a shoe, at what point can you write in your books that, yes, I have sold a shoe? You should have completed all the necessary activities. So if you are selling a shoe, and let's say the shoe is in your shop, can you go and record that you have sold shoe? No. A customer should be there who has taken delivery of that shoe before you can confidently say, oh, I've sold a shoe. So this concept is telling us about the timing when we can recognize revenue. And it states that it should be at the time the major economic activities have been completed. In fact, in sales transactions, you can only recognize revenue or sales when the ownership of the goods have been transferred to the buyer. So if you're a seller, until the ownership of the goods has been transferred to the buyer, you can't record sales. So let's go into the picture and maybe you would get the sense here. So there are two scenarios here. The first scenario, this man comes to this traveling and tour agency and says, I plan to have you make my travel arrangement. I plan. And in the second scenario, the customer has been sent on that tour, or so it says the client has taken the trip. Okay. So at that time, since the customer has taken the trip, the agency can record revenue. Again, it doesn't matter whether the customer has paid or not. But in as much as the major economic activity of making the arrangement for the person to travel has occurred, you can record revenue. But in the first scenario, you cannot record revenue because the person says, I plan. If I plan to make a travel, no major activity has occurred for you to claim some payment from me. Example, if you are selling a shoe to your friend and your shoe is in your bag, you can't say you have sold unless you transfer the shoe to the friend. Okay, so that's the realization concept. Please, any question? Any question, profs? Okay. I think you see, this is more practical. When you sit in a bus, okay, most of the time, ideally, this concept tells the driver to only record or to even ask for money when they have completed the journey. But in our case, it happens that we even pay before the journey the journey starts, right? So in practice, maybe one of these days we should try applying the realization concept, telling the drivers that until you get me to my destination, you haven't earned any money or you cannot realize any transport from me. Okay. Unless maybe the terms are that immediately you sit in the car, then you have to pay. Okay, so that's just by the way. The next concept is the dual aspect concept. The dual aspect concept. I think I'll let Prof. Ashley read this for me. Dual aspect concept. So Prof. Ashley, unmute and wait for us.
Sorry. This concept is the basic principle of accounting. It is the heart and soul. It's basically one of the golden rules of be a corresponding debit. So every transaction we record will be recorded in two places. This is the core concept of double entry system.
Okay, great. Thank you very much. So this dual aspect, dual means two, right? It's the basis for the double entry principle, which says that when a transaction occurs, there are twofold effects, a debit and a corresponding credit, or a credit and a corresponding debit. So the dual aspect concept is really seen as the heart and soul of accounting. Okay, because it is the basis for the golden rule or the double entry rule that we have been applying. Okay, so that is it about the dual aspect concept. Okay. And in reality, when you apply this principle, it makes sense because for every transaction that happens, you see two effects. For example, if you go to a shop and you buy a book, okay, the twofold effects from your perspective is that you are losing money and you are gaining a book. For the shop is losing a book and it's also getting money. So there's always that twofold effect that this concept speaks about. Okay. So yes, the double entry principle, debits should be equal to credit, etc. The next one is materiality concept. Materiality. Prof. Sandra, can you do the reading for us? Materiality concept.
Materiality concept. Materiality states that all material facts must be part of the accounting process, but immaterial facts, that is, insignificant information, should be left out or aggregated with items of similar nature and functions and need not be presented separately. The materiality of a transaction will depend on its nature, value, and its significance to the external user. If the information can affect a person's investing decision, then it is definitely a material fact.
Okay. Now, I always use this example to make students appreciate this concept of materiality. Let's say you write an exams and you score, as in SHS, you score, say, 96%, which is obviously an A, right? And then you go through your paper and you realize that your teacher did not add 1 mark to it. Would you be so much interested in fighting for the 1 mark? That's first scenario. The second scenario, you had 79. Okay, 79. Again, you went through and the teacher did not add 1 mark. In these two scenarios, which of them would you be fighting for the 1 mark? Is it the 96 or the 79? I want to hear your view on that.
79.
Great, the 79. And I think Prof. Sandra would say same because that 79 will earn you a B2. But if you fight for the 1 mark and it gets you to 80, that's an A. But in the case of the 96, you are already far. In fact, so you may not be willing to go fight for that 1 mark. So you see that the same 1 mark at one point is very significant and at another point is very insignificant. How is that determinable? It is based on the effect, the impact that information in our scenario, that 1 mark has on the external user. In our case, you, the student. Okay, so the materiality concept states that if an accountant is providing information, he should make sure that all significant facts, all information that would have an impact on the person who is going to use the information should be included, because those things become material. Okay? If the thing is insignificant, then you can leave it out, or you can even aggregate it with items of similar nature. Okay, so this concept really bothers about the significance of the fact you are providing and how it will affect or impact the users of accounting information. Okay, so if I'm to cite another example, if you look at MTN Ghana, for instance, MTN in presenting their account may omit, let's say, okay, let me go to a picture here and I think it will make sense, right? Imagine MTN Ghana putting on their balance sheet eraser, $1.99. Oh, what would this information be to the users of the information? A big company like MTN reporting on an eraser. It is insignificant, right? But as it is insignificant to MTN, you go to a certain company, that small item is very significant, because if you leave the information out, it is going to have an impact, or it is going to affect the user of an accounting information. Okay, so that's materiality concept. It bothers about the significance of the information being provided by the accountant. So that is to say, the accountant is to make sure that he provides all significant information that would have effect on the user of the information. If that information is not going to have any effect or impact, then it can be left out or aggregated. Okay. The next one is full disclosure. Full disclosure, I think Ashley will read it. I think I appreciate that you read it in terms for me. So full disclosure. Let's go, Ashley.
Full disclosure. This concept states that all relevant information must be disclosed in the accounting statements. A lot of external users depend on these financial statements for their information to make investing decisions. So no information or transactions, etc., of relevance to any one of them should be omitted from these statements for the benefit of the company.
Okay. In a way, this concept more or less like is similar to the materiality, right? But here, emphasis is on the fact that provide all relevant information, whether it is positive or negative. Whether it is positive or negative. In as much as the users will need that information, you should disclose it. So all relevant information should be provided. So if the business has made a loss, you have to state that yes, the business made a loss. You don't try to massage it and make it look like things are good when they are bad. Okay, so nothing should be left out, especially if the users are supposed to have that information. Okay. So I think I put a picture here about this famous story of Ananias and Sapphira, and I think you all appreciate this story when they didn't disclose how much they had received. Right? I think you all remember this story. So that's full disclosure. Don't omit anything. Give the full information. Okay. There are really quite a lot of them, right? I think this is the last but one. The next one is periodicity. periodicity from the word period. So this concept is really telling the accountant about the timing that information should be provided. Okay, so it says that information about the economic activities of an enterprise, okay, for specified time periods that are shorter than the life of the enterprise. Normally, the time periods are of equal length to facilitate comparison. The time periods is identified in the financial statement. They are usually of 12 months, sometimes quarterly or half yearly. These are considered interim and different from the annual statement. So you see, periodicity is saying that information should be provided at regular intervals, appropriate regular intervals. So in the business world, it's a norm that ideally at the end of every year or annually, businesses provide reports to their stakeholders like the owners, customers, the public, etc. Okay. However, they can also do what we call quarterly or half yearly reports. So periodicity is talking about providing information at appropriate regular intervals. And in most cases, businesses are supposed to provide annual information. Some even do half yearly and quarterly reports. Great. The last one we'll look at is objectivity. Objectivity. I think Sandra will read this for me. So, Prof. Sandra, over to you.
Objectivity. This concept states the obvious assumption that the accounting transaction recorded should be objective, that is, free from any bias of the person recording it. So each transaction should be verifiable by supporting documents like voucher, bills, letters, challans, certificates, invoice, etc.
Okay. So objectivity here means that the information should be free from any personal opinion or bias. So, for example, if I'm your father and I'm teaching you financial accounting and you do an exam and you score 60, I have to report the 60 because that's the objective view of your score. I shouldn't say, oh, but she's my daughter, I can't give her 60. Then maybe I add 20 marks for you to get 80 and A. That makes it bias, okay? Not so objective. So objectivity here means that the accountant should make sure that, okay, he gives information that is verifiable, that has, evidence backing it, like vouchers, receipts, okay? So if you say the business has made a sale of 100,000 cedis, what shows? There should be document backing that claim. Okay, it shouldn't be that you add the business. Oh, okay, the business has sold 150. Meanwhile, you don't have evidence supporting the 50, but only 100, right? So that's about the objectivity. Make sure you provide information that is free from your personal opinion and influences and biases. Okay, great. So dear professors, we've seen how many 13 accounting concepts and policies, and you might be asking yourself, how can I remember all these things? Fortunately for you, some of them, the meaning is in their names, right? But some you may have to try and commit to memory, okay? How are they examined? Most of the times they appear in your objective test, and there have been times that they appear in your practical, as in the theory part, where you are given certain scenarios and you are asked which of the concepts applies in such scenario. So I will urge you to go over the video if you have to. I'll share the notes with you as well, so you take them one by one. But if you are confused about any of them, please let me know. So quickly, let's run through. We have the going concern, number 1. So we start from going concern, went to the accrual and matching concept. Now these are 2 different concepts, but they work together. That's why you see them together. So we have the accrual concept, we have the matching concept. We went to the consistency, to the prudence or conservatism. In fact, for this, there has been a question. The prudence concept is also referred to as, then you see A, that B, conservatism. So note that down. And we went to the business entity, the historical cost, the money measurement, realization concept, dual aspect concept, materiality concept, to the full disclosure, periodicity, and finally objectivity. So 13 of them, I think professors should do well to remember them. So I have a few questions here. Okay, past questions for you to appreciate that this topic is also highly examinable. So I think we'll go through the questions together in the next session. But before we do that, if you have any question, if you want me to explain a particular concept, let me know.